Today's episode of M&A Science is brought to you by S&P Global Market Intelligence. If you're in Corp Dev or private equity, you know the pain. Good private company data is hard to come by. Everyone's still chasing clean, reliable, up-to-date data. I started out using CapIQ Pro for public comps, but didn't realize until recently how deep their private company coverage has gotten. Over 58 million private companies, global reach, and actually usable for real deal work. This isn't surface level. You get real metrics, ownership, financials, funding rounds, even asset level insights. So if you're still toggling between a dozen tools, trying to piece together the picture, maybe it's time to stop guessing and start sourcing better. Explore this data at spglobal.com/PCD-science. Again, that's spglobal.com/PCD-science. Or look for a link in the show notes.
Hello, M&A scientists. Welcome to the M&A Science Podcast. This podcast is part of a mission to rethink how M&A is done. The old school seller-led approach, it's dead. Buyer-led M&A is all about strategy, alignment, and efficiency, putting value creation at the center of every deal. Let's be real, it's not just about closing the deal. It's about making it successful. We uncover what truly works in M&A by learning directly from the best. For episodes, resources, and tools to elevate your M&A game, visit mascience.com and follow us on LinkedIn. I'm your host, Kisan Patel, founder and CEO of Deal Room and chief scientist at M&A Science. Today, I'm joined by Rachel Hindley, vice president of corporate development at IFS. With years of expertise in M&A strategy and execution, Rachel oversees transformative acquisitions that enhance IFS's portfolio and market presence. She has honed her skills in building relationships with sellers, coordinating complex integrations, and balancing the interests of IFS's three private equity backers, EQT, HG, and TA Associates. IFS is a cutting-edge cloud enterprise software company and a global leader in industrial AI, empowering businesses that manufacture, service, and manage complex assets to deliver exceptional outcomes at their moment of service. IFS combines organic growth with strategic acquisitions, including high-profile transactions such as Copperleaf and The Loops, to expand its capabilities and reach. Today, we'll learn how Rachel Hindley and the IFS corporate development team aligns deals with long-term strategy, integrates effectively, and balances the unique dynamics of multi-PE backing. Rachel, how are you?
Great. I'm excited to be here. Thank you for having me.
Thanks for hosting at your office here.
And welcome to the IFS studio.
Yeah, just outside of London. Mm-hmm. And I appreciate you taking the time from doing deals to have a conversation. Can we kick things off a little bit about your background?
Yeah, for sure. So I'm from New Zealand, and I started off my career at PwC in New Zealand in tax, and then I seconded over to London, like most Kiwis do, and I moved into the M&A tax structuring team in London. So that was mainly doing larger private equity deals, and that's when I first got sort of a flavour for the wider deal process. Became a lot more interested and like curious about it, and thought that I'd like to pivot. Which is not always so easy, right? So I moved sideways into transaction services, did some valuations at PwC, and then it was always my sort of aim to then want to move into like corporate development. So I went out and got a little bit of fund experience, and then managed to move into Corp Dev in Royal Mail, a very iconic British brand, and then moved over to IFS, where I am today. Incredibly, amazing team that I have, and we do super exciting deals. Obviously, in AI now. But I did, when I joined IFS, it was the first time I was working in software, which I had made clear, but it was a very steep learning curve. Like, it is literally another language.
What? Well, so the background went from IB Consulting. When you say funds, that private equity?
Yeah, it was an alternative investment fund. So
nice. That's a pretty well-rounded background. Got feet into the Corp Dev at Royal Mail.
Yeah.
Now at IFS, which is first tech role. What was the big difference that you saw from doing these sort of traditional industries versus tech?
God, yeah. Like, I mean, it was a huge move, I think, from professional services and that type through fund to Royal Mail. Like, I mean, that's sort of an iconic, obviously, brand, but it's also a huge dinosaur of a company. And it's like, thousands and thousands of people. And moving to IFS was, I think, like what I envisioned more of a corporate to be. Like, it's, it's fast paced because it's, growing rapidly, and it's really supported in an M&A environment. Whereas for Royal Mail, they had so many issues, like, in the core business that, M&A wasn't necessarily as well a supported function. Whereas at IFS it is, and it's an incredibly important part of the strategy. So it's a nice place to be.
It's fast paced. And just seeing that they have a different emphasis on M&A as part of their strategy. I
think probably because as well, we obviously have 3 very large, credible private equity shareholders as well.
Can we talk about that? Like, what? Because that's always interesting. And I think we've talked about it before, that just different timelines of investments can occur with them. And that may sort of have different influence. But how is it having 3 major private equity firms on the board?
I mean, I'd say, firstly, it is, like I said, it's incredible from a support perspective. I mean, just the fact that you obviously have private equity shareholders who do deals as a daily job, being in the M&A team of one of the portcos, you just feel so supported. And like I said, it's just, it's so motivating to work in an environment where M&A is like a very important pillar of the strategy. So that's one aspect that's, incredible. And also, the market downturn of the last few years in software. I mean, a lot of corporates would have been holding back on their M&A at that point. And, for us, we do very strategic M&A. So it's not, we're not just rolling up onto a platform. So it enabled us to continue to do M&A basically because we've got 3 pretty deep pockets as shareholders. And so we kept doing deals. We're not a high deal flow team because we don't, we typically integrate, but, it enabled us to keep going and keep acquiring where it made sense, which is also pretty amazing. And, given the market conditions have been so tough, right?
It's a lot of support. And the interesting thing, these are like highly reputable firms, right? EQT, HG, TA, they just great reputations across all 3 of them. I've seen that PE firms tend to have different operating models and how they support portfolio companies, just little different approaches in whether they're very hands-on versus prescriptive and so forth. Do you see that? Is there some sense of like there's a different way that they work? And like, I'm just wondering, like, does that play out well together? Do you get a cherry pick and get the best of?
I think so. Like, so EQT up until recently, obviously they've always been the majority shareholder. So they took us private in 2015. And then since then, it's been basically one of their most successful portcos ever. So instead of running the normal cycle, they've just every few years they've rolled it into a new fund and brought on a minority investor, which is why first it was TA and then it was HG in 22, and then just recently HG's increased their shareholding. So now EQT and HG are co-controllers. So historically, like EQT's always been, I'd say, just almost like the perfect balance. They are incredibly supportive. We liaise and, we use them to bounce ideas off and get feedback and give their perspective on valuation or DD and things like that. But they do let us run our own deals, so they're They don't heavily get involved in particularly smaller deals. They won't get involved in the actual deal process. We'll keep them abreast of, our DD summaries and business plans as we go. But they're not wanting to, be in the model and say, and say like, oh, you should be doing this or you should be doing that. There's quite a lot of trust there over the years because I think we've delivered pretty decent deals so far. And I think having HG come on has been really good as well. Obviously, they are a software-specific private equity fund. So the depth of knowledge that they have is incredible in the software space. Just having differing perspectives and differing, feedback come back to you. And even like, oh, have you thought about this? And you're like, oh, yeah, actually, no, I haven't. It's pretty incredible for a corporate development team. And then TA, they're a little bit more hands-off actually. But again, they all present a fairly united front to us. I mean, I can't really say too many bad things about them, to be honest, and really nice people.
Not on record, at least. Does it typically the majority owner have the most influence? Is it that always the case, or?
Yeah, it was until they didn't. So typically, I mean, each of our deals, unless it's a very small deal, will go to board approval, and each of the shareholders has someone on the board. So basically, it is really a collaborative board decision. I guess at the end of the day, if there was a scenario where EQT wasn't on board and the others were, they could probably assert the control then. But actually, there hasn't, since I've been at IFS anyway, there hasn't been a situation where they've vetoed a deal over the others.
Today's episode of M&A Science is brought to you by Grata. Grata is the leading private market deal-making platform. With its best-in-class AI workflows and investment-grade data, Grata helps investors, advisors, and strategic acquirers effortlessly discover, research, and connect with potential targets, all in one sleek, user-friendly interface. Now part of DataSight, Grata is bringing its platform to dealmakers around the world. From consolidated financials to precise comps, Grata offers dealmakers full visibility into their markets so they can find the right deals faster. Discover more, win more with Grata. Visit grata.com to learn more. That's grata.com.
Have you seen any challenges from having 3 different PE firms on the board?
Yeah, I mean, it comes with a definite level of complexity in that they, I'm sure, above my pay grade to know what their actual exit time horizons are, for example. And, we're a corporate business. We're looking at it from a long-term strategic perspective and what makes sense for the business. But we do have to obviously interplay that with what the business needs to look like, or, you want the KPIs to be strong in the year before and leading up to an exit event. So, for example, we've just had one, so this is a good time in the cycle now, right? Because, there's probably longer till another exit event. But, in the last few years, there's a few factors that make it difficult. IFS is such a strong performing business, on both the top line and our EBITDA. I mean, our Rule of 40 is like very high. And therefore, if you're finding a relatively large target, it's actually really difficult for us to find a business that's not dilutive to our KPIs. And we have to, or if, it's loss-making, but of really, strategic importance to the business, that would be really good for us long-term, but it's loss-making for the foreseeable, like next 18 months in a time leading up to an exit event, that makes it incredibly difficult to meet the priorities of the shareholders at the same time as meeting the priorities of the business. And what we do to try and mitigate that is we come up with a pretty robust business plan that really needs to be able to show a path to profitability within the next 18 months to 2 years, I would say. And that if we can show that it's of such strategic importance and it's going to be, in the future very accretive for the business, then I think that helps with the shareholders. But I don't think, for example, if it was loss-making and it was not growing well, that would just be a no-go. I mean, there has to be, when you're looking at the rule of 40, there has to be some benefit. You can't be loss-making and of poor growth and not have a trajectory to turn around within 18 months. I mean, we wouldn't buy a company like that anyway.
That's so interesting. Now I get the complexity because you have each PE firm's got their exit horizon, which is influencing their strategic view on the business. And then you have your business having its overall long-term vision that they're building a strategy against. And then when you look at your specific investment opportunities, some could be near-term accretive and some may be long-term, like all the AI stuff everybody's looking at right now. I mean, there's some distance out there. Balancing that out, it's
yeah, it can be really challenging, and we're seeing that, like you say, with the AI ones. I think what is easier for us, it's is if it's a smaller, like if it was a product bolt-on, it's an easier sell if it's not dilutive by virtue of materiality. So obviously IFS is pretty large now. That can be one mitigating factor, right? So if it is a smaller company, the dilution isn't there, then it doesn't sort of raise the same flags as if it's a larger dilutive company, but of high strategic importance. I mean, Copperleaf we acquired last year was of huge strategic interest to the business, and we actually chased that for quite a long time. It was a listed company in Vancouver. But we had and it was loss-making, but we had a very, very robust plan to turn that round to profitability, and I think we have. So it's one that we could see where we could execute well.
That's the big goal. I think the common ground you mentioned is that 18-month or so horizon to become profitable. Yeah. And then you can take those bets that may not
I think most people aim for that, don't they?
They say they do.
Or when you see the IMs, they're always like, we are going to be profitable in 18 months.
That's true.
Yeah.
And it's interesting because right now it's just some of those segments, like AI being one of them. I mean, they're trading at really high multipliers. What's your view on that? Like, what's the census between your company, even the PE, and everybody's looking at AI and making bets for it? I think that'll probably lend into just your view on M&A and just the different types of strategies and types of M&A that you execute.
I can talk to how we think about it in terms of archetypes, but also then laying in AI now as well. So traditionally we look at it across 4 different archetypes, and that helps us really set our investment thesis. And we try and make that then a little bit like, okay, well, if it's this archetype, then it's going to be this way forward in the business integration-wise. So, we have a product bolt-on archetype, and that's our, typically smaller companies basically looking to fill a gap in our current functionality. It might come about because the go-to-market team are feeding back to us that we're, in the loss feedback. It might be that a customer's highlighting a particular weaker part of the product versus competitors. And if they see that on a consistent basis, then that becomes a problem. And then we have to go and say to the R&D team, okay, well, is this in your roadmap for the next, 12 to 18 months? Okay, no, it's not. There's not enough resource there for it. Okay, well, that probably makes sense for M&A to go out and screen to fill that gap. It can be challenging, and the value sort of thesis is that, you integrate quickly because it's just a product integration. You can rationalize the synergy on the back office and usually on go-to-market. But the value creation is really is a little bit of a defensive case, right? Because you're saying, okay, well, we might lose these deals. We might be losing some deals if we don't have this functionality. It's really hard in a business case to say, okay, well, how much more are you selling? Because actually it's just part of IFS Cloud. Like, we have one main product, right? And it's hard to then say, okay, well, you can sell this for another 100K, because realistically what happens is they have a price list, and then you negotiate, the sellers negotiate on how much you pay for the product. But if you don't do it, then you might start losing deals. So it can be a difficult one, and we do it on a buy v build basis. You look at it, okay, well, how much does it cost to build? Problem is that hits your P&L. If you bring in more R&D resource. So actually doing M&A can be quite good because there's more funds usually for on the capital side to do it as an M&A rather than through a build scenario. And then another archetype we look at is customer migration. So that's essentially where we want to either consolidate in a particular segment. Often it's an industry basis. So, we might want to just increase our market share in an industry. So we stick to, our USP at IFS is that we're leaders in industrial AI. So we stick to 6 core industries like manufacturing, aerospace and defense, telco, energy utilities, construction, and field services. And we really stick to those industries. We don't really deviate too much out of it. So, for example, we did a deal in aerospace and defense of a migration case. So we just wanted to sort of take on some more share. It's obviously, big airlines, but it's a big deals, but a smaller market. And in that case, we would try and migrate the customers pretty quickly off their product onto our product. There's a fair amount of churn that goes into that. And then sunset the product as quickly as we can. And you can obviously get synergies through the back office. And then that's through sort of enhanced deals from having, better logos and better brand recognition in the market. Then we would have market entry type archetypes. So that's where we're going into sort of an adjacent segment. And then we would have, they'd have their own go-to-market team. We'd want to retain that. It might be, they might be in a certain industry, so have better expertise than we might because it's an adjacent segment. And Copperleaf was an example of that. So that was in asset investment planning. We're strong in enterprise asset management. That gives us a broader suite to offer to our customers. So like really good cross-sell revenue synergies. And also, then you can also sell it standalone, but also bundle it in with IFS Cloud. So we would still typically integrate for those types of transactions as well. And then the last one would be just a new strategic platform or like a new business line completely, where we would be, buying in the whole business to keep it. There wouldn't be a lot of synergy, there wouldn't be a lot of cost synergy there, for example, unless it was back office, because you're really looking to bring in a whole new line and drive a whole new go-to-market. So you're probably hiring more than getting rid of people. And the loops it was probably a good example of that, and a slightly like I guess segue into AI. In that, as with all software companies, we are having to move very quickly now into the AI space. So and we say we are leaders in industrial AI, but the market's just moving so quickly, right? So we acquired The Loops as of just a month ago, which was a small Silicon Valley startup in the agentic AI space. But in their go-to-market is customer experience, completely outside of our customer base. Obviously, we were a customer, which is how we got to know them. And they obviously sell to IT service companies and that type of thing. So what we've done is bought them not for their current go-to-market, but we bought them to basically form our entire agentic platform for IFS. And we are then going to build, or should be now, building our own IFS industrial agents on top of this platform to be able to roll out to our customers as our agentic offering. If we hadn't acquired The Loops, and it's a small business that, you end up, like you said, it's just a different world of valuation. You're looking at something more scaled. It would be hugely expensive, something that we wouldn't be able to afford to acquire. And this gives us basically a 18-month, 2-year head start. It was already in our roadmap. But I mean, now software companies can't afford to be talking about moving somewhere in 18 months because you would be totally redundant in that time. And it's almost to say that you don't want to, we acquire these to say we need to remain valid in the market and like not become a legacy like software business.
I want to make sure I can recap the 4 different archetypes.
Sorry, that was a lot of talking.
No, but this is good. This is good. I want to make sure I picked it up. So let me know if I missed anything. The first one we covered was bolt-ons. And this is essentially acquiring a feature set that maybe this would bridge a roadmap gap. It's a business that you would want to integrate quickly. And you mentioned this a lot of times could be more about defensibility, that, hey, this could help us be more competitive and win more deals as opposed to betting on just pure revenue synergies from it. Those are the bolt-ons. And then the migration cases are more focused on consolidation, or you want to increase market share in a certain area. So there's a more buy-in competitive product, and you're likely to try to migrate the customers as fast as possible and sunset their technology so you can achieve the cost synergies from it. And then we have market entry. This is when you're moving into adjacent spaces. Use the example of having the asset management product and then acquiring the investment planning, which would be a nice adjacency that could fit into maybe a cross-sell with your existing platform.
Yeah.
And then the new platform acquisitions, when you're buying a whole new business line, something that can have a completely different go-to-market, which is where we use the Loops example and bring in agentic AI that's becoming a whole new offering to your customer base.
Exactly. Spot on.
I'm ready to go work in Corp Dev now. Like, I got it. This is...
Software Corp Dev, yeah.
What now? The AI is interesting because you used the example of looking at it as a whole new platform. Could that fit in any of the archetypes if you're looking at AI companies?
Of our current archetypes?
Yeah, because you could say, hey, here's feature set, but now maybe it's not like a whole new platform like the Agentic example, but here's like AI features because everybody's talking. I'm just wondering if how do you think of just AI in general as it fits into your strategy? Is it more about building out this new products completely, or is it also looked at as enhancing current products? I don't know.
Yeah, it is. And it's because a lot of it is for our current customer base. So this is where, customers that already have our IFS Cloud product. I mean, when we look at IFS Cloud, like historically it was, an ERP backbone, and then it's enterprise asset management and field services management. So it's, it's all your sort of core software. So you're still going to, companies are still going to need all of that software. It's just that you'll then have all of the AI and agentic motions to go with that. So a lot of it is basically not replacing what they already have. They'll still need to have IFS Cloud for all of their systems of record, right? We're, still systems of record for all your asset maintenance and things like that. And the agentic and AI still need to be able to extract all of that data. So this is one of the things we're doing with the loops that takes time, and it's probably going a bit technical, but they need to build these connectors through to IFS Cloud because you need to have all of the data to be able to still then build the agents to go and, orchestrate all of their, use case. But they still need access to data. So you can't just say, hey, I'm just going to go and sell you our agentic offering.
It's part of the suite.
It's part of it. So it's like an enhancement. And, we're at the moment, IFS is going out and doing, going out to customers, our larger customers and taking a team basically to go and customize AI solutions for them. But these are all current customers to start with. And then obviously for new customers, it'll be an offering of IFS Cloud with the AI packages along with them.
Got it.
This is coming from, I don't want to go over my skis. I'm not a technical person.
Well, as you were talking through, I was starting to think of we talked about just how integration, I guess I was thinking about the first example, if it's acquiring feature sets for the bolt-on, fully integrate quickly. And now I was trying to get a sense of what's the variability of integration. Because when you do a whole new platform, But then you use this example with AI, like it's ultimately feeding back into overall platform that's your system of record.
Yeah.
So it just seems like there's a level of integration. Does it vary in terms of just partially versus fully integrating?
For AI or just in general?
In general, I guess, because I guess AI just part of the piece.
Yeah. So integration typically, like as I said, this is why we're not a high deal flow team. We look at sort of 4 to 6 deals a year. I mean, it's slightly increasing, I think, with the level of ambition. But realistically, why that is because we typically integrate. We are a strategic acquirer. Like it's all, typically to enhance our current offerings for our customers, so that we can sell more into the broader set. On that basis, like if I look at our archetypes, we would always integrate product bolt-ons, migration cases, and typically market entry. Where we don't fully integrate, and an example of this was we acquired Poka a couple of years ago, and they are a smaller connected worker platform. That was our first foray into something that was more frontline worker focused rather than IFS is more about the asset side of it. In that case, there were 2 young guys that were the founders, really lovely guys, and we have kept them standalone actually, so we haven't integrated them at all. And I think the thinking was because it's not necessary to integrate the product into IFS Cloud. It can be, we have a connector so that you can sell it alongside or like bundle it with IFS Cloud, but you can also sell it standalone to their current market. It was thought that like they're relatively agile, like dynamic company, that sometimes that's better to hold standalone rather than, overlaying the like huge, larger behemoth of a corporate onto them. That, obviously the founders will feel it and the core management because they still have to report through to IFS. But, you get the beauty of being able to leverage IFS for all its like go-to-market engine and scalability and like knowledge. They utilize Sri Lanka like to take on new resources. It's like for more offshoring, but they can still retain their a little bit more like dynamic entrepreneurial type style, and it's gone really well. So they're smashing
I rarely hear about this. Usually, it's cut it off. They've put the website. We've been acquired. We're no longer selling direct.
No, this is like, well, I mean, you can talk to the founders might have a different view, but I was checking in on them the other day. They're going really well and like beating targets. So I think it has, and I think and something like cross-sell is always really difficult. And I think most people will talk about this in software companies. It's, it sounds good in theory, but it's quite hard sometimes to orchestrate just because, you have to get the sellers aligned to actually sell the product. And it might be a smaller company. So if it's a smaller company and it's lower ARR, are these sellers who are incentivized to hit their quotas going to take on a lower ARR product, if they can do a bigger sale elsewhere? So they need to align incentives as well to do it. But I hear that it's actually going pretty well, and they are doing really well as a business. I think striking the balance between staying standalone, but then having, like a parent here who can actually provide value to you and support.
Yeah, that's interesting. It'd be fun to talk to them because here's your organic path to growth that they had in mind. And then obviously you have a vision of how it's going to be accretive with your broader ecosystem.
Yeah.
Does that, and a lot of the thinking is always like, let's focus on this new strategy. And then, like I said, that's how all these tales of startups getting blown up by large organizations happen is because of that, because it's easy to, small company can be fragile at that growth stage they're at. But what I was curious is that there's like so much more overhead trying to do both, where you're trying to create, maintain their current growth, but then also achieve the big drivers that you expected from them from the larger company side.
I don't think so. So a lot of it is, it's, there are aspects to the setup because there are, for example, some third-party contract or like intercompany contracts in place to like make it arm's length. that it's definitely not integrated. But I don't think there was a whole another layer of overhead put on the business. And I think more so they've managed to, and there's probably a recharge in there, but they've managed to leverage IFS quite well as well in the areas where they were probably lacking. And there is the element, like you picked up on there, that there might be a different strategy that they were thinking about in their head versus there could be a strategy that IFS are thinking about, and those two strategies long-term might be different. So that's something that, they would have to be aware of, right? Because they've been acquired. Like there's certain aspects to being acquired. For example, we help them with, a separate track on M&A, for example. We actually do help them think about their own separate M&A strategy for Poka and what would make sense for them.
I talk a lot about buyer-led M&A. I'm trying to create some kind of cult movement of... and a lot of it's just a lot of these podcasts and working with Corp Dev, they just see aspects. It's like, why don't we put this all together in a framework? And one of the pillars is connecting diligence integration. Because I feel like this diligence itself is the foundation for your integration planning. And I'm curious, because you're coming from larger organizations, I know you have a bunch of different work streams. How do you do that? How do you approach diligence on a company like this, where it's smaller in size, larger entity, cover your basis on the diligence, and then set up for a successful integration? What
is good is that in commercial diligence, we have a point person for every work stream, and that person is, where possible, the same person on each of our deals. So there's now an M&A kind of commercial lead, usually on top of their day job. And where possible, that same person is the integration lead as well. And I think this is where things are really, we've refined it and it's getting a lot better, is that we have a pretty seamless approach to it now, because all of the people who are involved in the commercial diligence have all the knowledge, all the insight, and then are the same, hopefully, set of people that do the integration. So ideally, there shouldn't be this, gap where things fall through the cracks between the people handing off the deal to the integration team.
So at the function, it's the same person that's doing diligence and is responsible for the integration.
Yeah, so we try and make it fairly repeatable. For example, things like, your underlying technology and architecture, anything back office related, anything on the support organization, because that's agnostic to a deal. Obviously, depending on the industry, then that's where it differs. It might be a different R&D product team, because if it's A&D, it'll be the A&D team, and there'll be an A&D go-to-market team. So that's where, it gets more specific. But in general, across a lot of the work streams that are standardized, it can be the same person. And that is working really well, because we try and run pretty tight deal timelines. Because we involve so many people in the process, we want to minimize the amount of distraction, both to the management team of the target and to our organization. So we try and run them quite fast, but people are they know what the process is. We have pretty standardized management meeting agendas. We only outsource, the standard things of finance, legal, tax, insurance. Because we integrate most of our deals, and because we are a strategic acquirer, not a platform roll-up, the people, product is usually one of the most important things, and go-to-market, those people have the most expertise in our business to be able to opine on it versus a third party, because they're going to have to understand how it integrates into IFS. How does it fit with our current product? How does it fit with our current go-to-market? No one else, no other commercial diligence provider can tell us that. We have the best expertise in-house, so it works really well.
Keep it in-house, because ultimately you should own the work.
Yeah. And I
chuckle because some of the stuff ends up on LinkedIn, and I get comments from folks that want to sell services. It's like, I was curious about, this is one that I've been thinking about, is customer diligence, where in some of the stuff, it's looking at competitive products. And there's already this bunch of sensitivity about talking to the customers or engaging with them. I don't know if you've ever had any experience with that, like getting a third party to?
So we always do VOC as part of our diligence.
What do you call it? VSC?
Yeah, voice of the customer.
Oh, okay. Okay.
Sorry. So we do two types. We do one typically really early on, which is more outside in. So we'll engage a provider that's, there's many of them out there now, but that works with, identifying either customers, or if we want to know about, get glimpses from past employees, et cetera, as to the business. So we do that type of diligence, which is usually super useful as long as you get a good 8 to 10 interviews. And then once we're in the process, we run a customer diligence as well. So we'll get the management or founder CEO to do the warm introductions, and we'll ask them for their top, depending on the size of the business, but we'll ask them for, say, their top 10, 15 ARR customers. And then they'll have to outreach to all of those customers with a kind of warm introduction for this other outfit we use, with the guise of a operational, feedback session, to say we're wanting, to get feedback from our customers, and it's all kind of, so you can.
So the customer doesn't know. They just think it's just, hey, we're gathering general feedback.
Yeah, because it's warmed up by the management. Yeah. And then it's really effective because it is with a third party. So they tend to be very honest. It's not like they're like, oh, we better not say anything bad about the company. And then what is really useful as well is that unless it's something terrifying and we cut the deal, we package it up. And then when we've closed the deal, we give it all to management, because there's really good insights into how they can improve.
I just want one question on the survey. How likely are you to churn on the next renewal?
Yes, we do. And so it's part of it. Our supplier will have it in their report, and it will list red, amber, and green around their likelihood to churn.
This is cool. To me, this is one of the biggest things, and it's helpful actually hear how you approach it when working on these kind of software deals. It's just, you want to know the quality of revenue. You want to know what direction it's going, what churn risk is. Does it still apply with these mitigation deals? Because that's another one where if you don't have a predictability on that churn from mitigation, it can really throw your model off.
Oh, sorry. On migration.
Oh, sorry. Yeah, migration. Yeah, so on mitigation. I'm sorry, wrong. Migration.
Migration, yes. It's different because we can't ask them if they're going to migrate to us during a deal process.
That's what makes it tough.
Yeah.
So how do you predict it? Maybe you got past experience to reference.
Yeah.
But that's one I've been struggling with is.
So we look at it, the way we model it is, I would say fairly conservatively. And yes, we look at past experience as to levels of churn, but it forms part of the case. So you will have a certain proportion of migration each year, then you'll have a certain proportion of churn, and then you'll have a final churn, because obviously the customers in 5 years' time that haven't migrated are pretty likely to churn. But then you get the uplift as well on the conversion. So, these cases, a lot of them, in reality, they have to, they are likely to want to upgrade, to migrate, because they want to be able to use the functionality.
So
we hope.
That's why when you model these things out, it's here's bolt-ons that are more defense-oriented deals. Here's migration, which is you're betting on how much you're going to lose. And then you have market entry, which to me sounds the most interesting. There's some clear cross-sell and uplift opportunities there. Are there a certain category that's clearly better investments than others?
I think it's just that.
I feel like everybody still wants a high valuation, especially in software.
Yeah, but then it is that thing, right? Like I said, product bolt-ons are so, they're actually really difficult cases for us to build, because it is really hard to prove the value thesis. Having said that, there was one that we were looking at where it was just so clear that they were referencing it in loss feedbacks on deals. So where you have it like actually referenced that this particular functionality is weak multiple times, even if it doesn't seem to make sense, it just becomes a like, well, we have to get it because it actually is like, and then you can, what we do is then we just, we state the number of deals that have stated this, and then you're like, well, you're losing X number of ARR because you haven't, because we haven't plugged that gap or we haven't got strong enough functionality. So it doesn't, it's not the most exciting, like you say. I mean, doing a copper leaf or the loops is exciting, but they are still really important deals. And also just to, consolidate the space sometimes. If other vendors are going to do it, you don't want to miss out either. So I think they've all got their place, but I agree, it's more exciting to do market entry transactions.
Wouldn't the deals get more, I don't know, where it's complicated but unpredictable the further away you get from your core?
And I think that's another big thing is that, there's a lot of leaning in the business. And that also means that there's a lot of executive lean in, because when it goes to, our go, no go, which is essentially like the C-suite signing off on a deal, every single C-suite person has to agree. And that means that they have to understand and have signed off on what their work stream has said, either in DD or in the assumptions in the business case. So from that point of view, I think it's like incredibly important that, you have the expertise and then you have the executive to sign off. Where you get away from the core, obviously you have less expertise in the business. And that's where, it can get a little bit more uncomfortable, because we're used to having a lot of it being easier to say like, well, I really believe in this. And then you can trust that person understands like why it's a good investment. Once you get away from the core, then that's when I said that's when we start to bring in more third-party providers, because suddenly we're like, well, this isn't like, for example, AI and the loops. Like we didn't have agentic, we didn't have a strong agentic level of expertise in the business yet. We've been investing in a lot, obviously, of resource and AI. So we needed the validate. Our executives wanted validation from third party to say, okay, well, is this a defensible moat? Could this founder go off? We close the deal, we don't manage to retain them, and could he go and build it in his garage in 3 months? It's that kind of thing which the business at the moment we didn't have the expertise to opine on. So we need to go out and get that third party validation.
So know what you don't know.
Yeah.
I brought up revenue and customer because that's my big ticket that I'm learning right now, especially looking at that in diligence and bridging it over to integration. What's your big ticket in terms of really nailing down from diligence to integration, set up the deal for success?
As in what's important from going from due diligence into integration?
Yeah, and just in general with the deal, make sure you don't screw this up and things will go well.
Integration.
Well, if you click into it, what does that mean?
I know. So, and this is it's interesting because I don't typically get involved in integration. Our team does origination through to execution, and then we are obviously involved in integration from the outset, because the very lead from the outset of the deal, the overall integration lead starts with us and runs with us right from the beginning.
So they're there in the beginning,
doing the planning as well,
and then they're quarterbacking all those work stream leads that are overlapping.
We co-lead basically the commercial diligence, because realistically the integration head is the person that's actually going to be responsible for all those work streams going forward. So actually in a deal process, the Corp Dev team and the integration lead co-lead.
That's actually interesting.
Commercial diligence, which makes sense because that person is going to be the person taking it further. I would say, in terms of the question, having seen and helping out on one of the integrations, it's so important to separate, and it might sound very simple, what systems integration is versus value creation. And I don't know, like, people talk about integration they'll just say, and, we need to do the integration. But actually, I think sometimes people are confusing what integration is. Systems integration, some people just think it's systems integration. And it's like, well, our IT team like run and project manage systems integration. That's integrating people, processes, systems, getting them on the email and all that kind of thing, invoicing and, the practical elements, which are very important. But the whole piece around value creation is really where you lose the value of a deal, right? Like you have a business, and this is what I did learn in the deal process now, having seen integration, is that you go out into the business, we talk to go-to-market, we talk to R&D, we talk to everyone, and like we build our business case around, what can we do, how can we drive synergies, how can we do cross-sell, where are the cost synergies? And then you take that, this case is signed off, by the board. There's an executive sponsor who's accountable for the whole thing. And then you move it, and then we close the deal. And then integration takes over. But if you don't have a slick value creation plan, which really, is derived from all the points in the business case or how you're going to hit the numbers, you're just, you so quickly can lose value because, our business cases, like I said, if you're talking about an 18-month to 2-year turnaround, if it was loss-making, well, you've got to really get out of the blocks pretty quickly. So, if you have to hire another 10 heads to help you sell, well, you need to get onto the recruitment. And it's the value creation piece, which is where it's so easy to lose the value of a deal. And you'd know from talking to everyone, but it's momentum, right? So if you're out the blocks slow, it's not the first year because usually there's momentum in their own pipeline, etc. But if you're not putting in place all of the things that we wanted to do to drive the business case and to hit hit the numbers 2 years out, that's where you start running into trouble, because you have to be like on top of what each person, what each work stream said they were going to do. And it's all good and well that we talk about it during the deal and we're like, yes, we'll do that, and we'll drive cross-sell this way, and we'll get these people, we'll get this team to help sell that. And then you're like, have they started doing that? No, they haven't.
It's like the integration plan really needs to be built around this North Star of what the value creation, I guess, vision is, but it then turns into an executable plan of the integration plan. And then you have your tactical stuff you got to do where people, and this where I hear the stories of people getting lost in integration. It turns into the checkbox activity because, hey, I downloaded this template off the website on how to integrate a company, and this is what we're doing.
It's literally driven off what is in your business case. You can't just get a template and say this is what is a successful integration. It's like, well, what did you say? How many deals did you say you were going to sell additionally next year, and how are you going to sell them? And what do you need to do to get there to sell them? And that's what should be in your value creation plan.
Now you have that part of value creation plan, which drives integration plan. I'm curious about the cultural piece because we haven't brought it up yet, and it comes up in every conversation. How do you look at that part of it? Is there, elements or just considerations around that part? Does that affect how you integrate a company?
Oh yeah, for sure. And I use that example with Poka, right? Like we wanted to retain their, they were young, and we wanted to retain they were in Quebec, very different culture. And where you want to retain the people in the business, you have to be very, very careful, obviously, about culture. I mean, it's like common sense. I'm sure some people where, if you're going to remove half the business, you're at risk of removing the culture anyway. But I mean, the Loops is a good example. So, they're a Silicon Valley startup. That's like worlds away from someone like IFS. And, and I was talking obviously to the founders every day, and it's such simple things, but, I was very cognizant of making sure that it was super important on this deal that we retain the team. I mean, the R&D team particularly, they're mainly an R&D team. I mean, an agentic AI. We needed all of them. And So it was like one of the first questions, how do we make sure, other than, there's the whole retention side around the monetary retention side, but that's not enough usually for these types of people to retain them. It's like the way that they like to work. So there was really seemingly simple things, but important to them. So we allowed them to keep MacBooks. We don't have MacBooks. I mean, it sounds silly, right? But like, it was super important. Like, imagine having to make them go onto like a, Dell laptop. I mean, it would change their way of working. And,
Well, it's so true. I remember I had a vendor, and during the process, they got acquired by big, top 10 tech company. And it was funny because I'm talking to the sales rep, our account executive. I was just curious, like, how's the integration going? And he was like, this and that. And then they finally opened up. He's like, one thing that pissed me off was they took away Slack. And I asked him, I said, well, do you think it like impacted productivity? He's like, huge. Like, we religiously use Slack. Now we got to use this other crap product that everybody hates.
Yeah, and like, people don't think about it as something that's seemingly simple, because you'd be like, of course you just integrate the system. But if it changed your entire business's way of working for a small company as well. So we were, things like MacBooks.
You took away my MacBook. I wouldn't be happy about it.
No, well, I don't use one. Even things like tooling. Obviously, we can't allow the whole of IFS isn't able to just use, whatever tooling, or like go and get trials of tooling and to use in product. They were used to being able to do that, to enable them to work quickly or efficiently, or like they were obviously in that world, so they could, they'd be like, oh, let's, trial this new product, new tool. So to a certain degree, we have to, there's a bit of complexity around obviously making sure that the security protocols are there now that they've been acquired, but allowing that as well, but which is different to the rest of the organization. But it's like you're still asking them to do a really different type of like piece of work. So we were, for that, cultural retention of culture was so important. And I think, and I always make sure, this is one thing I do make sure in deals, is that we stay close to, particularly in founder-led deals, you stay really close to the founders and that you're dealing with, because there can be a lot of confusion if it's like, if it's their first rodeo, for example, then it's, it's all new to them. Usually they should have a good advisor, but it's just, things can be confusing, right? Like, I don't know, they need to roll a certain amount of their shares into IFS equity. Do they really understand it? We bring in, the expert in the equity to make sure that they understand it. Any concerns about, you don't want to feel like you don't know who to talk to, or like this bit was confusing that someone told me, but you also don't want, 50 people coming at them either. So we try and make sure that we keep it streamlined, and they know that they can ask us anything really, and approach us and say like, I need help with this. And I think it helps avoid confusion where they don't know what, for example, she was like, oh, what can I communicate out to my employees day one? It's all that type of thing. It's just making sure that there's like continuity and, transparency, basically.
There's a lot. You have to be mindful with culture, and that's going to help shape how you integrate the company. And there's going to be some trade-offs there. Your company is very distributed. Where was the company founded? It was
Sweden.
In Sweden. Nice.
It was an interesting story because it started with 3 guys from university who pitched a tent outside a nuclear power plant in Sweden, and they were asked to do like basically set up their really initial basic asset management system. So they just slept in a tent next to the power plant, and that was the beginnings of IFS. So we do say that like we try and, obviously as a business gets larger, it's difficult and you grow globally, but we do say that we try and maintain that original kind of entrepreneurial spirit, like the resilience, grit is like some of our core values. And I do think it like resonates, like people are always willing to lean in, get their hands dirty. And, I see that with M&A, like super supportive, and always giving you time. And this is senior executives as well.
Resilience, grit. The Swedes are always friendly. Is that part of the culture too?
Are they? No, jokes.
Well, they've got
that's offline. No, they are.
They can be pretty forward too.
Yeah.
Friendly and forward. Maybe can we strike the balance
and they
there?
holiday for the whole of July. So that's handy.
I know. I met a lot of them when I was in south of France the last couple of weeks.
I'd like to do that too. But no, we still have a strong Scandinavian presence. But obviously we have, a large amount of employees in Sri Lanka now as well.
Companies diversified. Is your M&A team is diversified and decentralized as well?
No, so we are pretty much UK centric team.
Okay.
Because a lot of the executive team are UK based now.
Got it.
And it's kind of where we obviously sit closely to like them and the inorganic strategy of the business. I think like we do all of the deals globally. To be fair, we do a lot of North American deals, but we orchestrate it all from here.
Wow, all central here.
Yeah,
that's interesting. That's a whole other interview for us to maybe even actually a group. I can think of podcasts I've done where it's completely decentralized to very centralized to in between.
Yeah,
we'll have to pick that up. I think that'd be a great. We do a quarterly head of Corp Dev conversation. I think that'd be a fun topic to kind of break down of just.
I know, because I can see how there would be benefits to having, North American-based people. Having said that, like I don't know how teams work, but we have, for example, our core support functions, say of like legal, tax, finance. So we have a North American tax person who then supports us on from a tax perspective. We're not doing that.
Well, the thing. Excuse me. The thing I was curious about was getting actionability on these deals. If that's what was part of it, and I've seen it a lot with like roll-ups, right? If you're doing an international roll-up, you definitely have localized biz dev folks that are really, sourcing and getting the deals actionable. How does that work with your organization? Are you directly there talking to the founders and getting them to that point that they're ready to sell? Is it business unit leader leading that? Is it CEOs of the firm? Is it everybody?
Yeah,
Does it get them on a Zoom call with 100 people? And
not at that point. We do a lot of origination in our team as well. But that is another great benefit of 3 massive private equity shareholders is that our network is huge.
That's a big part of their playbook.
Exactly. They can, look at how many, they would do it to all their portcos.
How does that work? Do they, in terms of pipeline, because a lot of times a PE firm has a pipeline that they're using to support their portcos. So do you have like 3 pipelines within the 3 different PE firms and then your own?
No, I don't know whether so we have a monthly check-in with them where we run them through our whole pipeline. Which is useful because, if new things come on that we haven't briefed them on, often they'll say, we know the CEO or someone knows the CEO. So it's just like the network, the network is incredible, right? For having three large PE funds.
Okay, so you get intros through.
So we get intros through them. But obviously they do, I don't know exactly how it works because obviously, you've got, they assess so many targets and then often they'll be like, we decided this one would be better for you. They must sit there and decide which portco it would make sense for then hand it down to them. So there is that angle as well. But we do a lot of, it's a big business and I find, I don't know if you find this, that software's, relatively incestuous, that a lot of people know each other. They've all come from, the big ones. A lot of them are SAP or Oracle or Microsoft. So, then they have quite a vast network as well. So people will come to us in the business and say, hey, I was at dinner with such and such from this company, quite interesting. So we do get a lot of people that, that network within the business as well. And then obviously the standard bankers, and we're in touch with a lot of bankers, so we're well connected through the States, through North America and Europe.
What percentage of your deals are banked deals or in a bank process versus proprietary?
I'd say lower in terms of processes for us of late. We much prefer bilateral because we can. We
call it buyer-led.
Buyer-led, bilateral, right? same. We much prefer it because obviously we have the chance to build a relationship. We don't have to. Whilst we like to run deal timelines quite quickly, that's from the start of LOI. Like pre-LOI, we prefer to spend, because we do strategic deals, we prefer to spend a bit of time being able to evaluate whether it makes sense for the business. So we as a team do quite a lot of work with our internal teams in the go-to-market and R&D, really evaluating whether it makes sense for us to even bid on the target. Obviously, in processes, you're under a lot more pressure because you've got a deadline, and you just have to decide whether to go in or not. So,
after you've outbid everybody else, you did I get the right deal?
And then you're like, ooh.
And you shortcut the whole diligence process so you can hit the timeline to outbid everybody else.
And you're like, we didn't do any diligence. No.
I just talked to a CEO of one of our customers, and he was very adamant that he wants to spend a total 12 months relationship building before before he's comfortable to do that deal.
I know, and it's so important. And we are spending less time face-to-face than we used to, which I think is a positive since COVID, to be fair. But I still think it's incredibly important to have the face-to-face at some point to build the relationship. How do you think
it's I feel like now, before it was so much easier to be like, hey, I'm coming in town. Thought it'd be great to go meet up for a coffee, a drink or something. Now it's just, you just need to throw in as part of the process a Zoom call for an intro.
Yeah.
At least do that part to all right, we vibe good enough.
Yeah.
And then, hey, I'm coming in town. Can we grab?
Yeah. Which I think, I don't know, what do you think? I think everyone's used to that now.
That was the one thing that surprised me moving to New York, because I was used to New York before COVID, and you always just met people directly in person. That was it. Now moving there, that's the one thing that threw me off was, even though you're literally a 5-minute walk, you still do a Zoom call first. and then when you do meet up, it's almost like, hey, let's just vet out over a quick, the 30-minute slot. Then when you meet in person, the quality's there, and that's what I prefer. And especially if certain relationships, right, with a private equity firm, the potential target, you want to get to that point. And then that's where I was kind of curious about, how do you get these deals really actionable? Trust is obviously a huge element, and it does take some time. I mean, I think 1 year is fair to say. I don't know what your timeline is before, and maybe it isn't. Maybe it's just more of frequency and just.
Yeah, it massively depends. I mean, like I said, we tried to acquire Copperleaf for about 2 years for various reasons. Obviously, it's listed, so there's challenges. But so yeah, that took a long time. Poka. I think one thing that IFS does really well is that Darren, who was the previous CEO, Darren Roos, he is executive chairman now. He's always been very invested in M&A and closely involved in a lot of the deals. And for example, with Poka, it was a process, and we flew the two young founders out here, and kind of Darren was there, and he was CEO then, and gave them the full IFS story and charm. But I mean, it's also pretty impressive that the CEO of a large business is investing that time as well, and I think that's always been something that we've done well. Our current CEO, Mark Moffat, and Darren, they will always spend time with the founders and management and invest. And I think that gives people a level of you realize that we're serious, but also, a level of comfort around it as well, that, that we're not going to be flaky or, that we're not serious, basically.
You got to spend the time to build the trust. you flying them in. I was thinking about one of the PE firms when they invite you to the golf retreat.
Yeah.
But not everybody's on private equity sort of model to do that. But is there anything? I don't know. I think it's just the time to build a relationship. I don't think it's like a magic whether you're going to the sport game or just hanging out at the pub.
Yeah, if you have time, like if I agree, and there are some types of deals where for sure we touch base every so often, and we're building a relationship. But I mean, you must see now, like with AI and the way the market's, the pace that the market is moving. You don't have as much time. You don't have a year to build a relationship with a company in AI if you need that functionality. Like you.
That's maybe you turn up the frequency to saying, "Hey, I got a call. Hey, you know what? Why don't I come out in a couple of weeks and let's spend some time talking
and
more."
I think just giving and we did this with the loops. Like we came in. It wasn't a proper process, but they were talking to some people and we came in fairly late. But I think we also. Again, we delivered a vision to them. We didn't just say like we're interested in buying your company. We delivered. We and this was again Darren and Mark like articulated what it would mean for IFS and what they could be part of in IFS. I mean, it was incredibly important that we retained them in this deal. And one of the founders is, I think it was his seventh. Business. So there was a fair amount of risk that we wouldn't be able to redeem. But I think they are, and they ended up, really excited and like bought into our strategy for their business, which was a different strategy to what their current strategy was. But I think by involving them, being transparent and bringing them along on the journey and asking for their advice, basically, because, they were experts in something that we weren't. I think that makes you feel part of the process rather than like, I just want to pay this amount of money for your company.
That's an interesting point where a lot of times you think of courting of pitching and just, hey, here's this vision I have, how we can grow together, but also being very open-minded and learning from that company. And I think them getting a sense of it that, hey, there's actually reception for me to get heard and make a difference and what that could look like. I think that there's some, I'm making me kind of reflect on the pitches that I've received, from different investors. And you don't feel that this is like a real two-way relationship dialogue, that there's going to be influences on both sides.
Yes, because otherwise, like you might feel like this is still like your baby, right? Like most for founder-led businesses. So you don't want to feel like they're just going to rip it apart or.
Well, you're just following their playbook and trying to execute it. And that's, I think, like a founder's fear is like you end up with a job.
Yeah, exactly. And do you know what that, and are people transparent about what that job's going to be? And particularly for the loops, like we went out to Silicon Valley with the core deal team and we hosted pretty much just more workshops rather than, they're very young companies. So there's only so much due diligence you can do. But what was more important was working out what we wanted to do with with their product. And I think that wasn't even set before we went. And then, you could see the team collaborating with them to reach a conclusion which maybe they hadn't really anticipated themselves, right? That basically, actually, we came to the decision that it didn't make sense to continue on their go-to-market strategy. Had we not done the workshop and discussed it, and everyone was just contributing as much as the next person, because they're coming into the business, right? As founders, they're actually coming into to IFS. They have to roll a meaningful amount of their shares into IFS, so they have to be fairly aligned with where IFS are going in the strategy.
Pre-LOI.
No, this is post LOI.
Oh, post LOI. So you're still continuing having these like strategy workshops to.
Yeah, this was kind of like strategy DD workshops to work out basically. I mean, it was a bit of a more difficult business plan to put together because you're creating something completely new that we didn't have a playbook for. So we needed them to be able to help us.
Right. And then they're at least vested in to go execute on the agreed upon plan.
Yeah, it was super important.
When we look at just the whole market and how things are evolving, how does IFS adapt its M&A strategy itself to stay ahead in a just fast-moving software industry, but also the whole ecosystem seems to be moving pretty quickly with AI and other changes?
Yeah, it is. And we're definitely seeing that at the moment. I mean, our acquisition of the Loops was one. I mean, it was much earlier stage than we would typically acquire, smaller, and with that comes more risk for a corporate, and we're PE backed, not VC backed. But I think what we're seeing and what some of the PE firms that we talk to are saying is that it's because it's evolving and moving so quickly. It's almost like PE has to make some bets as well. It's not the same environment as it was. And, I was talking to one PE firm that said, had I known what I know today, would I have made some investments that we did 1 year ago? And that seems like such a short amount of time, but that's how fast the market's moving. And so now it feels a bit more like you don't have time, and you PE might have to be a bit more VC-like and make a few more bets and think, okay, well, maybe, 3 of the 6 will pull off.
Hey, before we wrap up, I got to ask you one thing. What's the craziest thing you've seen in M&A?
Oh, yeah. To be honest, I haven't seen a lot of really crazy stuff in corporate development, which is good. I'd say a long time ago, I feel like the market's changed now, but I did see in a different type of world, an executive walk in and fire an entire team in the office in one day. So that was fairly...
This is like part of a deal where you just close the deal and it's like everybody's fired. No,
it's just a team. It's incredible. But anyway, it wasn't me.
You saw it firsthand that they came in and fired the whole team. How'd that go down? Was he yelling at them and just said, "You're all fired"?
It was a very weird environment, to be honest. But yeah.
We should go have a drink after this. I think I'd love to hear the rest of that story.
Sure, offline.
Rachel, this has been a great interview. I appreciate you taking the time to have this conversation. You've helped me become a better M&A scientist.
Great, and I've loved it. Thank you for having me.
Those of you still listening, you're also a fellow M&A scientist. I appreciate you sticking through. I always love to hear feedback, especially from folks that can have attention span a lot longer than mine to sit through and listen to this. Reach out to me. I love connecting with folks on LinkedIn. I actually was at the hotel and somebody just shouted out, said, "Hey, Kisan."
Okay.
And it was so funny because it was my daughter, and it was like, because she does a lot of content with me. It's like, I see it on LinkedIn.
You're famous.
I know, it was so funny. He was with his family. And I had a few other times before randomly. I was in Miami with my son getting gelato, and somebody I recognized you. So I thought it was like so funny. I'm like,
did he think you were cool? Or?
My son didn't. Maybe my daughter does, but she doesn't I feel like she's 14. So
you're definitely
she finds her way to make a point of like, Dad, you're not that cool no matter what. But if you do, please connect with me on LinkedIn. Love getting feedback and the criticism. I take it. I'm looking to get better at this. Till next time, here's to the deal.